So we're delighted to have with us Erez Katz and also Taylor from his staff, from his group. They have given some excellent talks recently in various forums that just provide an outstanding survey of work being done, not only by them, but by, in general, in the financial machine learning area. They have some certain unique services they're offering that they'll mention along the way. But primarily, Erez said that he's interested in thought leadership and projecting a little thought leadership. So we're not really marketing anything. He's not really marketing anything specific, although they do have some services they can offer through interactive brokers. With that, I'm going to hand it over to Erez. Please take it away, Erez.
Thank you so much. So thanks for inviting us. Number one, it's great to see a group of investment enthusiasts. I would imagine all of you guys are. And obviously the area of machine learning and AI and data science probably excites you as much as it excites us at Neuravest. I'm here with Taylor Korf. Taylor is our head of R&D. Actually, he built most of the technology that drives our technology capabilities. But to your point, Don, we're not going to be selling anything today. We're going to be talking about machine learning and concepts. And to make it very useful for you as a whole, we're going to talk about a whole bunch of stuff, from data science to machine learning to model building, and of course, portfolio construction and investment management from algorithmic perspective. We're going to stop every section of the presentation and provide some time for questions and answers. And of course, at the end, we'll have a much more broad Q&A session. So thanks again for inviting us. I think the logistics are that if you guys have any question, maybe you can pause or post those questions in the Q&A section of the in the webinar, and we should be able to answer those as they come. A little bit about who we are and who I am. So I'm the CEO, co-founder of Neuravest. This is an evolution of a previous business called Lucena Research. We've been in the machine learning, AI for investments research for quite a few years, about 8 or 9 years now. The Neuravest name is a new name that just came about last year. We had a transaction with a fairly astute serial entrepreneur who's been very successful. And his name is Seth Marin, and he was the founder of LiquidNet. Sold it for who knows how many hundreds of millions of dollars to a UK firm. And he and I have been talking for a while and decided that this is a good time to kind of join forces and put some capital behind the company and really grow it to its next phase of its evolution. I'm actually calling you guys from our New York office. We have two locations, one in Atlanta, one in New York City. And what we do is we basically create machine learning research from data perspective, and we create and construct portfolios that are completely algorithmically traded. So the whole notion is that the human provides the insights, the intuition for a strategy, but once we develop the technology and the strategy goes live, it actually goes into a live interface with IBKR, as you mentioned correctly, Don, and other OMS, EMS, and brokerage that can support fixed interface. And we can execute trades electronically from a source, which is our platform. So anyway, that's what we do. In the context of the type of offerings that we do, we have 3 types of model portfolios. When I say model portfolios, it's really portfolios that are running on our domain in the cloud, and they can actually sync in real time with the destination AUM in a brokerage account. So we can detect how much AUM is on the other side. We figure out the allocation that needs to be mapped from our portfolio in our model to the external portfolios that we connect to. And then we very quickly, it's in the milliseconds, it synchronizes with trades to ensure that everything is fully in sync as far as the allocations between the two portfolios. This is kind of how it works. So all the smarts, all the logic sits down on the server side. And we have 3 types of portfolios. We have thematic portfolios. These are mostly predicated upon some idea that one of our experts, portfolio managers or analysts had come up with. And we put that concept into code, obviously create a baseline with a back test. It's all part of our portfolio, part of our platform. And then we can improve it with data and machine learning models. And I'll talk about that a little bit more. What does data really mean? These are not the typical data you would see in a balance sheet or P&L or earnings report. This is really more of an alternative data. Of course, we use that data as well, but also unique data sets that are coming from other sources that you would not expect to be used in the context of machine learning research for investment. Anything from newsfeed sentiment, social media sentiment, transactions from e-receipts, and the list goes on. There's about 40 or so data providers that we partner with to create those unique models that can create those informative decisions about investments. All again, algorithmically traded. Once we have these thematic portfolios, it can be anything from ESG portfolios to foreign exchange to long short equity to global macro to pairs trading. You name it, we have intraday strategies as well as multi-month strategies. So high latency and low latency. We're not in the high frequency domain, but we pretty much cover a wide array of asset types as well as investment styles. We can actually combine multiple portfolios together into a multi-strat investment, by which you can get 5, 6, maybe 10, 12 uncorrelated strategies together. And we'll talk about how to do that and how to create that notion of moving of assets, of capital between uncorrelated thematic portfolios to create a winning scenario for any market. So we can go long, short, we can leverage up, leverage down, based on market risk, multi-factors. This is what the Portfolio Plus that you see in the center here. And of course, the third one is the easiest one to explain is bespoke solutions. So people have ideas. We have a lot of folks who used to be PMs in large wirehouses that wanted to go on their own, and they want to put ideas to paper, and from paper to code, and code to enhancement with machine learning and data science. This is what we do. And then, of course, putting it together into a completely, again, algorithmic traded solution that goes into their destination portfolio or broker account. Anyway, this is kind of the offerings that we do. Now, in today's presentation, what I'd like to do is take you through a cycle of what does it take really to build a professional model that can potentially run not millions, but hundreds of millions of dollars, potentially even billions of dollars. And how do we go about doing the research? What are the steps? And of course, what are the gotchas and the caveats that you have to be aware of if you were to build something like that on your own, and what to look for? So the cycle is pretty easy to understand. We start with an idea. Some human obviously have to have the idea, the intuition. From that, we basically collaborate with our data science team to see if we can actually have data that can collaborate or corroborate the idea that somebody has, whether it's fixed income investment, for example. We can look at data that relates to fixed income. If it's equity or large caps, or long short, we have different data sets that can really apply to different scenarios. And of course, once the data is identified, we validate the data. We have a process by which we take the data and we kind of run scenarios and see if it's really informative for the objective that we're trying to design the data for. And of course, at that point, we start to create something called features, feature engineering, and then work with the quant team to build models. And ultimately, we go to market. Once the models are built, back tested, and validated, of course, we do perpetual trading with paper trading simulation. We'll talk about all these things down the road. But ultimately, it's not the end of the day when you actually go to market, because you have an evolutionary process of iterative improvement to the strategy as you go through its life cycle. So it's a never-ending scenario, and as you probably very well aware of, some of the strategies will work really well in some domains, some regime, and they won't work very well in others. And the idea is to identify what works well or not. And we have this notion of multi-strat, like I mentioned before. We can move things in and out dynamically. I'll talk about more of that in the next few slides. All right, so before we get into building models, we have to assess if data is predictive or not. And how do you go about doing that? So thinking about data, like I said before, there's a bunch of data set that we actually are working with. Anything from fundamental, technical, that's the usual suspects, which I'm sure you guys are very familiar with. And some of the more obscure data sets, for example, real estate activity, the supply quotient in the real estate market, for example. Or if you look at, earnings report, the transcript from the earnings report, you can understand the lexicon of how a CEO or CFO talk about their company, and how do you make a distinction between the previous tonality of the communication and what it is now, and evaluate if there's any type of hidden risk in how they describe their earnings. There's also, of course, the footnotes in an earnings report in a company's earnings, and how do you identify through NLP, natural language processing, how earning distortion, as we call it, how earnings may not completely represent this true story of the company. There's a one-off cases by which there is an impact on the balance sheet that could potentially be temporary, but would not necessarily tell the story for the future. So anyway, that's the kind of stuff that data can really provide you with. We work with Equifax, for example, which is a credit company. You guys probably know who they are. But just think about it. If you have a bird's eye view of all the US population, or majority of US population, and see how people are paying, not individual, because it's all anonymized, but as a whole, as a trend in the entire country. How are people paying their bills? Are people paying the credit card on time in full? The balance on the credit card? How many new mortgage applications were open? How credit scores are trending up or down for different segments of the economy and the demographics? And these are very valuable information that can really be a gold mine as you forecast what's to come. So this is how we evaluate data sets. And the whole idea about data, that it comes in different formats, different cadence. Some data updates every day, some data updates every week, every month, every quarter. But how do you create a database that can actually have a coexistence of multiple data sets into one cohesive structure, that you can actually take pieces from one data set and another and combine them together into a multi-factor model that can be effectively predictive, right? And that's the challenge. And there's ways to do that, normalizing data, creating some sort of a sentiment score as it relates to potential impact on a price of a stock. That's kind of what we're trying to really identify here. Anyway, I want to stop here real quick to see any questions up to this point, and then we'll move on with the more exciting part. So any questions at all? And Don, I'll let you guys kind of maybe quarterback the questions, and I'll be happy to provide answers if there are any.
Anybody got any questions? I don't see any other in the transcript or in the log, other than one, which is, will the slides be available?
Yeah, we'll make him available.
Great, thank you.
For sure. And it's recorded, so you can probably see it in the recording as well.
All right, great,
perfect. Let's talk about how do we go about getting data validated. So obviously, the first thing is to ingest the raw data into our database. And that's just the nature of getting data in its raw format, putting it into rows and columns in the database. We have a process called DQE, which is Data Qualification Engine. And what it does, it just tests the data for multiple, what we call superficial structural validation. For example, that there's no blanks or nans in the data. That the data does not have only representation of surviving stocks. If it goes back in history, you want the historical stock that no longer exists or have merged or became maybe pink sheet in one phase or another, but they used to be in the S&P 500 or maybe the Russell 1000 in the past. You want to have what we call survivor bias-free data, so you can actually represent dead stocks historically as well. All these pieces, about 12 checkpoints that we do check for, are covered in this number 2 stage here. Once we finish the validation in the DQE, it's basically does a lot of information coefficient, alpha decay. There's a decile breakdown of the numerical quantitative measures that the data provides, and checks and compared between the top decile as far as the values to the bottom decile. These are all superficial kind of tests to see that the data is actually somewhat structurally sound for further research. If it fails there, we just say thank you, but no thanks, because we don't want to spend time on researching data that may not have good chances to be successful. Quants are expensive, and quant's time is expensive. It's a scarce resource. We want to make sure we use it effectively. So we want to fail fast. So that's what the DQ is there, just to fail fast and provide the foundation for research that has a chance to have a good, decent outcome. Once we pass the first validation, we go into what we call scrubbing, aggregation, and mapping to symbology. So sometimes data does not come completely nice and clean and structured in a way that you can see a sentiment score, a date, and a symbol, which is really the minimum that you need to have to start building models from. So what we do, we aggregate the data and we create some sort of a uniformly distributed format of the data that it can really coexist. For example, if you look at the earnings per share or earnings in general, big companies have much larger earnings than small companies, but you try to normalize the data in a way that can really be a fair comparison between large and small companies. So you have some sort of a normalization process. You do earnings per share, which is one way of normalizing the earnings numbers. But obviously, there's a lot more to normalizing and distributing the data in a way that can be compared effectively between different companies on the same data set. For example, we work with a very large, prominent news company. Some companies have very few articles per day. Some of them have many more articles per day. But we really don't care necessarily about the notional number of articles per day. We want to see how much change there is, right? What's the cadence of change from normality that detects those opportunities for investment? So if a company has on the average 5 articles per day, and one day they have 50 articles, something substantial had happened just by the sheer number of articles. Forget about the content of the articles through natural language processing to identify the sentiment of the article towards the company. These are very important measures to create what we call normalizing and ranking. You can see here on number 4. That's part of the feature engineering, and that's what we do to create really value from the data. And only then, after we get the feature engineering, the normalization and ranking of companies, it can be compared against each other, even if they're different sizes. And of course, extrapolating and interpolating. This is one of the ways to create a uniform cadence of data. For example, if earnings is only coming up once a month, what do you do when you compare? You try to build a model that has daily values. So, in many cases, you carry the last known value forward, or you create some sort of a abstraction of trend from point A to point B, where you fill in the blanks between months. If you have a monthly data, for example, which is Equifax is monthly data, you can actually carry forward the data between the 2 months through some sort of a autoregressor or Holtz-Winter, which is ways to kind of create a deseasoned type of data representation. Anyway, at the end of all of that, we build the machine learning models, and then we go into the back testing and perpetually paper trading simulating the actual models themselves. And only then we can actually turn the model to execute the trades in real life with real money. The story is that between backtesting, paper trading, and live trading, on our platform, it's the same thing in a way, because it runs the same algo, either historically or perpetually, and ultimately it just synchronizes the allocations between our portfolio and our platform to the destination one on the brokerage account. So it's really one of the same from our perspective. And of course, we go into production, and we have multiple ways of deploying the data or the models. We have KPI forecasting, we have model portfolios, and we have something called smart data feed, which is if somebody doesn't want us to trade for them, they just want to get the signals, we can do that as well. So this is kind of the process. I see is one question here. Let's see, a few questions here. Let me just quickly jump into those. This is applicable to stocks, to foreign exchange, to futures, to ETFs, and fixed income. Even though we haven't really gotten to a live deployment of fixed income, we're getting into it now. just because fixed income is becoming now more and more electronically traded, which is really what we're after. How big is the Neuravest team? We have about 30 folks, mostly technologists, mostly scientists and quants. And again, we have 2 offices, one in Atlanta and one in New York. IBKR is one of the brokers that we work with. We actually work with other brokerage, more specific to futures, for example, with Iron Beam and Rhythmic and other types of, but essentially any type of fixed API or fixed interface would be sufficient for us to do our magic. All right, let's move on. So one of the biggest problems that I see with young people or people who are new entrants to the space is how to validate the data effectively so it's authentic, so it's not going to give you any false positive or false expectations. You heard the term overfitting or curve fitting. How do you avoid that to the best that you can, and what to look for? And one of the biggest thing is to make sure that we look at data. It's usually time series data. It's data that travels along, it's temporal data that basically travels over time. How do you make sure that the data is authentic? So what you do is you break down the time frame of the data to 4 distinct non-overlapping periods. There's a training, validation, holdout, and future. And the reason is because you don't want to train and validate on the same data set, because that's basically going to create a scenario that's perfectly designed. Because when you train, it's called supervised learning. You basically tell the machine what to look for. If it makes a mistake, you tell the machine how far it was from where it needs to be, so it can correct itself. It's a very highly iterative process to train a model that can provide outcome in line with the desired outcome. So that's the training model, the training of the models. But if you try and you train thousands of iterations, eventually you're going to come up with something that looks a little decent, even though it may not be informative. The only way to make sure it's informative is to try that model on a new data set, not on the same data, because that's what you trained it for. It's already tainted from that perspective, is to look at something else, which is a new period of time that's not overlapping, called the validation period. Now imagine you train the model, you got a great result in the training, you went to validation and it fell flat on its face. So what do? You go back to the drawing board, you train again till you get something else, then you try to validate it again. And you do it many, many times over, and that's the problem. You do it too many times, guess what happens? Something called selection bias. You actually have tried so many times, very much like you tried in the training period. After so many iterations, you'll be able to find that shape in the clouds in the sky, or you're going to be able to find that model, that's going to work for you in validation. But that doesn't mean that it's working really well, because you tried so many times, you're going to fall by accident into something that may not be sustainable. So one way to even further validate is get one more set of data that's called the holdout data that nobody's supposed to see ever during that validation or training process. And again, test that model against the holdout. If it fails on the holdout, you basically dump the whole idea and you basically try a new data set or a new concept altogether. But if it does work well with the holdout, then you go into what's called perpetual trading, which is basically, it's in green here. And that's basically a paper trading simulation of the same model to see if it works on future data. So there's no look back bias. There's no way you know what's going to happen, and it'll give you that extra, validation process that's working well. I see one more question here. Market signals. So talk about MACD, RSI. These are all technical factors. These are interesting factors that we use, but a lot more than that. We use quite a bit factors that are just from different data sets. For example, the newsfeed sentiment, for example. We can give you for any day how the news looks at a company, what's the favorability of the newsfeed. So we aggregate all the articles and all the sentiments of the articles towards a company, and we can give you a score. Very much like a MACD or an RSI goes over 30 or below 70 when it's overbought or oversold. you can have a very similar concept with the newsfeed sentiment, this the alternative data. That's what we call alternative data. And if you have a sentiment score above X percent or X value between 0 and 100, that's a buying opportunity. And if it's below a certain value, it's a sell short opportunity. So that's kind of the same concept on technical functions you can do with alternative data as well. I see you have a question about sector rotation. Yes, we have actually a very interesting model that uses that technology that I'm just showing you here that identifies sector rotation. It's, actually, I have an article on my LinkedIn. If you guys feel free to connect with me on LinkedIn after this webinar. You'll see the mother of all sector rotation strategies. You can read more about what we've done there, but it's a long, short, per sector, market neutral strategy that can rotate between those sectors as well. So it's got multiple flavors of long, short, per sector, as well as rotating in between them. So it's fairly involved, but it's a pretty cool strategy. All right. One thing that I want to mention is a model does not stay stagnant. So you have, let's say you found a really nice factor model. So you have RSI and MACD, as you mentioned in one of the questions here. And at the same time, you found that if you go above, 35 RSI and you're going, above a certain value of the MACD, it's a buying opportunity. But that model is only applicable to the time frame that it was trained on. And as you know, market is very, very dynamic. It's a non-stationary problem we're trying to solve. So the way to do that is to train the models perpetually on a roll forward basis. You can see here your training and validation, during the holdout, as well as in a real live scenario. So the models keep retraining to adjust themselves to the market condition. That's what you call adaptive AI. That's kind of what we're what we're selling here, really, the whole notion of a self-correcting type of machine learning intelligence that adapts to the market in real time. Yeah, one question came here real quick here. Is the same AI engine used for all of your models, but for different training data? No, each model has its own world of data and models and techniques, not just in the construction of the strategy, but also in the execution, the portfolio construction, stop loss conditions, target gain. There's a whole bunch of logic that goes into the full product beyond just the signals themselves. Okay. I'm going to go quickly here through these reports, and when I get Taylor to start telling you about some of the more exciting stuff, which is the machine learning building model. But in any event, you can see here, for example, this is what DQE looks like. You can see how we provide this pass or fail grade for each one of those tests that we check on the data itself. It's all fully automated within our platform. And by the way, these are live reports. I can go and show you what it looks like real quick here on our platform. So these are things we can generate with a push of a button very, very quickly. And it's really powerful stuff. So just so you know, this is not just a dog and pony show. This is stuff that we actually use and live and breathe pretty much daily. And if we have time, I'm going to show you a demo of our platform as well. All right, let's move on to the next slide. Okay, this is Taylor's turn now, model building. I took enough time here out of the clock. So Taylor, take it away, model building.
All right, I'm up. Yeah, so this is going to be kind of a high level how we build models here, how a lot of people build models. And I'll keep it high level here, but if you have more in-depth questions, please feel free to go as technical as you want in chat. So Erez mentioned alternative data before. Let me preface all this by saying data is the lifeblood of any model. If you don't have good data, if your data isn't formatted correctly or cleaned or scrubbed, nothing's going to work. There's no machine learning model that can do magic. So the first step is to decide what our model is going to be predicting, or maybe better stated, what our models are going to be predicting. And the idea here is we're trying to teach a computer to generalize a problem. And so oftentimes it's useful for us as the humans to help the model along a little bit. There are certain things you need to do to get these algorithms to understand the data. But what we'll often see is that the problems we're trying to generalize are often actually several problems. So see here in this picture, we have what looks to be some sort of graph, and it looks very, very connected with certain clusters of color there. I mentioned that models need to generalize, but how do you generalize a model across two companies that don't behave the same? This is especially true with alternative data. The same value could have drastically different meanings for one stock versus another. Ideally, we would cluster similarly behaving stocks together and use those stocks and give them a model, and then another cluster gets a different model, and then we can kind of segment our models this way. And the idea is that they each get their own basket, or as I called it before, or as we call it, a cluster. So how do we do that? First intuitive way is, hey, why don't we use GICS codes? Why don't we use ICB codes? The problem with those is that they're human labels, and they're very prone to bias and even more prone to pigeonholing. One good example of this is, where does Amazon belong in this chart? Is it a technology stock? Is it a retailer? Good question. Better way, or a better approach, at least for a machine learning model, is to use the data to identify which stocks behave similarly. When that stock zigs, what other stocks zig with it? When that stock zags, what other stocks zag with it? By using that data, we can remove that bias that I'm talking about and have a more agnostic modeling process. By grouping similar securities together, we achieve something called stationality within the groups, which helps kind of boost signal to noise ratio. Erez, if you want to go to the next slide, I'm actually a slide ahead in my head right now. So here's actually a zoom in of that chart. And I want to be very clear, we did not tell this model that these were all energy stocks. It found it out on its own. We didn't say, oh, these are, here's the GICS codes, go figure it out. I don't even think we gave it pricing data on this one. I think we gave it some alternative data set and some fundamentals. And it went out and it learned these relationships. Now, sometimes you're going to get relationships that go from one cluster to another. But for the most part, if you look at these names, you'll see that they all look like energy stocks. Here's Duke. There's I'm actually not very familiar with all of these tickers, to be honest with you. But so yeah, I covered.
Taylor, we lost you. I think we lost you there, or it's only me.
Oh, that's strange. I got muted.
We can hear you now. Yeah.
Where did I leave off?
You just you went to Duke, and you didn't know these are all, of course,
excellent
energy companies. Yes.
So the general idea here is that we want to help the model generalize, and if we group things together that are similar, that's a big first step into getting there. So next slide. So we figured out how to group our data together and build different models that are more relevant. What's the next thing we should focus on? Well, it's going to be the inputs to those models. There are generally two types of inputs. The first is what we would call an independent variable, or I guess in layman's terms, that's what you're using to predict what am I considering as data. And the other is going to be your dependent variable, which is what I'm trying to predict. So on the left is going to be the independent variables. So these are our inputs. We might want to consider things like PE ratios or fundamentals or alternative data of some sort. What does credit card spending look like? What are the analysts saying about this data set? One thing that's very important when you're building a model is that the data needs to be standardized. And all that means is that the data that the model sees needs to fall on a consistent range, not just for that one feature, but across all the features. A standard way to do this is to normalize it between 0 and 1, to scale it essentially. Another thing you can do is to divide that data by its standard deviation, which is called z-scoring. That's another great way to normalize data. This provides two benefits. One, machines are not that smart. They need to see data that is on the same scale, and then that scale needs to be consistent across all the features and across time. It doesn't help if suddenly I train in 2016 and my features are between 0 and 1, but in 2017 they're between 1 and 2. The model's not going to have any idea what's going on. So normalization is very, very important. It's not only important for your X values though, or your independent variables. It's also important for what you're trying to predict. Now, for the purposes of discussion, let's just consider what I would call a classification model. And all that means is that what we're considering is binary, meaning buy or don't buy. What's a good way of making that classification label of buy or don't buy? One simple approach might be, are the returns greater than 0 21 days from now? That's great, but it's not normalized. Let me give you an example. If I have a company that is very, very volatile, and it's moving up and down, and it's constantly oscillating around being profitable or not profitable. And on the 21st day of my labeling process, it's just slightly positive. That's not something we want the machine to learn, right? And there are several other edge cases like that. What if the company loses money for 20 days and on the 21st day, it just barely makes a little bit of money? That's not something we want to train a machine to take advantage of. And frankly, because it probably won't learn anything. That's probably noise. So first approach is let's increase our threshold. Greater than 0 isn't good enough. How about greater than 3%? A 3% move over 1 month, that seems pretty decent. But then you have to consider that not all stocks have the same volatility. If I'm trying to train a model that understands both Tesla and Microsoft, they're completely in 2 different categories in terms of classification. Tesla might be up or down 3% on an even day. Microsoft is obviously a little bit more stable, hopefully. Not recently. So it's important that we take these returns and we normalize them. And a simple way to do that is to normalize them by their volatility. We can simply take that 21-day return and we can divide it by the average daily variance or by some historical volatility. So now you have a thing that you're predicting that is normalized and then thresholded. And that's important for machines to be able to generalize and also to be able to learn things that are actionable in the end.
Taylor, there's a few questions here. Let me interject you real quick here, if I may. If I may just add a couple of anecdotes here to this slide. You can see those cones here, right? There's multiple cones. As Taylor said, the different sizes of cones, depending on what the volatility was historically, you can actually create a wider cone or narrower cone, but the label, which is what you train the machine for, is to say, hey, in a period of time, I'd like to see how can we make the machine identify that the trend is going to intersect the upper bound of the cone before the lower bound of the cone, right? So it's not really an actual percentage that we're targeting or an actual time frame that we're targeting. We're targeting pretty much a behavior that is going to create a winning signal. It's a binary signal, a buy or sell or do nothing. It's really three states in a classification here that says, if you have a conviction that you are going to hit the upper bound of the cone based on the historical volatility, that's a buy signal. Otherwise, if it's going to hit the lower part of the cone in the next n number of days before it hits the upper bound of the cone, it's a short signal. If you don't know, you have no conviction, it's a do nothing. Anyway, some of the questions that we have here is, what's a typical holding period in days for a stock, and how many stocks do you hold in a portfolio at a given time? So obviously the answer is it depends. But truly, every time you are going to identify a fixed value for your strategy, you are inserting bias, as Taylor said. Right? So think about it. You are targeting 1% return. By the way, when you say percent return, you have to always qualify it with a market relative return or a benchmark relative return. The absolute return is not going to be as important because if everything goes higher, it's highly correlated. You're not really providing any more new information. You want to try and go higher than the benchmark or lower than the benchmark if you're targeting shorts. But in general, there's no discrete number of days that we're targeting, number of positions we target. We basically say we are going to essentially evaluate if every day you evaluate if I should be holding this position today. Every day you basically make that evaluation. Now the idea is that you're going to have Apple, for example, continuously being signals as hold until one day no longer does. And that's when you take that position out of the portfolio. So it's not a fixed number of days. It's basically evaluated on a day-by-day basis to identify if signal still holds. And if it doesn't anymore, then you make room for other signals that may be more relevant at that time. Anything else you wanted to add here, Taylor, to the question about holding periods and how many stocks?
No, I think you said it well.
Also, somebody asked about hyperparameter searching. That's a good question. So we use all of the above. We use grid search, which is actually a brute force of any permutation at many times. We do Bayesian processes to kind of guesstimate sampling of the data. And we do something that's interesting that I haven't seen in your question here, which is something called genetic algorithm, GA, to identify feature selection and feature importance. There's actually easier and cheaper methods to do that, but we use a lot of techniques to create an efficient hyperparameter optimization, which is, I think, what you're asking about. Let's see, deep learning. Yeah, so we use both deep learning and classical, traditional, deep learning, machine learning technology. It depends on the situation. The biggest challenge is data, right? You'll be surprised, but with all the story about data and all the data facts that we use here, the financial markets, and Taylor will tell you, is the one notoriously that is most scarce in amount of data that's available. Just think about it. If you earnings report, every quarter, so you got 10 years of earnings report, and you have 4 quarters per year, it's 40 data points. It's not enough for deep learning research. You have to use more traditional machine learning research for that. But if you go after intra-day strategies, which is tick data, and you have 1 second, 1 millisecond data, then you have much more data to work with. You can go into deep learning technology and CNN, convolutional neural network, more pattern detection, and things we can talk about in a few more slides down here. So it depends on the situation. We're not going to use technology just because it's cool. It has to be applicable for the scenario that we're trying to address it with. Okay, one more question, and then we're going to move on, Taylor. What percentage of the system is fully automated from entry signal, position, sizing, exit signal, even if it's 1% of manual intervention allowed? So the answer is no manual intervention, completely machine driven. I mean, the only manual intervention if something goes bad, you have any type of failure that you need to interject manually. Let's say you have a lost connection between our system and interactive brokers. That's a big alarm that we have bells ringing, and we have to obviously get in there and manually resolve if there's any trades that are in motion. But in general, it's completely automated, not even 1% manual intervention. That's the key here. Is humans are notoriously going to make errors in these type of decisions, and I think we found that the machines are doing a much better job. Okay, Taylor, please carry on. We're going to go to the other questions subsequently.
Yeah, absolutely. And I can't stress enough about the deep learning thing. That is a buzzword of buzzwords. There's no, if I'm looking at quarterly reports, there's no deep learning models for that. Deep learning models require millions and millions of data points. That's primarily used in other domains of machine learning, like image classification and stuff. Now, if you go to a finer resolution, and I'm working with intraday data, then you potentially have something to work with in terms of deep learning models. But don't go about buying a deep learning model for quarterly predictions. It doesn't exist. So we built a model. We've done all of our work correctly. I mentioned before, it's a classification model. How do you go about evaluating a model? There's a lot of ways you can do that. A most common way might be accuracy, right? How many times was I right? How many times was I wrong? The problem with that is, especially in finance, there's this bias called class imbalance. And class imbalance is basically this. Imagine that 90% of the observations that I show my machine are times that it should not take a trade, and 10% are times that it should take a trade. Or imagine it's the other way around for the purposes of this argument. Let's imagine that 90% are good opportunities, 10 are bad opportunities. To get 90% accuracy, my model only has to learn to take every opportunity. That's not a good metric, especially if I have a heavily imbalanced class. So this is true in a lot of other domains, and obviously there are ways around it. One good metric to combat this is what's called an ROC curve. It stands for receiver operator curve. It has something to do with in World War II with radars. Erez, you might know better, but
it's how the British the British Air Force used to detect enemy aircraft versus friendly aircraft using some sort of a statistical method of analyzing the features of the aircraft, and they use a very similar technique that we're using here for analyzing the likelihood of a model to be successful or not. So anyway, that's the source.
So you see two charts here, and they're the same two distributions, red and green. And basically what a model is attempting to do is to separate these distributions. If a model is really good, these distributions don't overlap at all. If a model isn't as good, they're going to be right on top of each other. What you'll see is that if you can, when you get to this point, you can make a decision on how you threshold your model. How do you determine the model sentiment and whether it's buy or don't buy? For our purposes in finance, we want to limit our false positives. That means we want to limit the amount of times that we buy something and it's a bad decision. The exact opposite is true for medical cases. For example, if I want to tell someone whether they have some horrible disease, I probably want to limit my false negatives. I don't want to tell someone they're not sick if they really are. And it's okay if I tell a couple people that they are sick if they're not. They can just take the test again. So that's an example where on the left, I might have a threshold that is way to the left. I don't want any of the green to be thresholded off. Whereas if for our cases, we want the threshold to be way to the right. We want to make sure we don't have any false positive. We want any of the red to be to the right of our threshold. So that's an example of how even after the model's already been built, you can further tune it to suit your needs as to whether you're okay with more risk or whether you want to be completely risk adverse.
Yeah, great. It's a great slide. I have a few questions here just to quickly make sure we don't lose track of them. So sorry for making it a little spotty here, but these are great questions here. So one of the questions was, how much of the market is moved by AI at this time? And that's a great question. I don't have a good answer, but I tell you what I do know. I do know that there's a lot of movements that is moved by algorithmic approaches. And I'm not sure what percentage of the market, but these are the most moving market is algorithmic. If you think about, what moved the market during, the labor report, the employment report just came out last Friday. There was a huge spike in activity as a result of that. It's all coming from algorithmic, trades that are responding to signals, responding to movements in the market that are coming from fundamental, macroecon, but it's driving a lot of the algos in and out. So I think electronically, people, from what I've read recently, like 90% of the trades are traded electronically. And I would imagine these numbers are going to get even higher and higher as time goes on. That's one question. The other question is about, let me see, typical number of features in a model. That's a very good question, actually. So people think about, we have about 950 factors that can describe any security at any given time with all the data sets. Just think about how many signals we can get from 950 total factors. Many of them actually are kind of not very useful at many times. Some of them are useful only in certain times, but in general, to make sure you don't create a model that's overfit that basically create a scenario that's not reproducible in other markets, you have to have a general solution. For that, you need to have very few features in a model. For us, a typical model would be 3, 4, maybe 5 features, but that's it. You can have multiple models. Each one contains 4 or 5 features. And then you can have something called an ensemble voting mechanism, which basically you can have each model, they have to be uncorrelated, would vote for a buy or a sell in a given stock. You tally all the votes together and create some sort of a aggregate voting mechanism to identify the confidence of multiple models in the decision of a buy or sell. These, by the way, are the most successful strategies when you have this ensemble voting mechanism. But each model itself can be maybe 3, 4, maximum, from what I've seen, 5 factors, but not more than that. So you want to add anything here on the number of features in the model?
Yeah, I think that's accurate. It depends on the model, obviously. Yeah, I mean, the less amount of data you have, generally the less features you're going to be able to employ before you start running into the curse of dimensionality is what it's called. And so.
Yeah, and last question here, and I want to just take a shot at is, do you do scaling in, scaling out, scaling in respect to positions? And absolutely we do. So when you have intraday, it's much more pronounced. How do you get in and out of positions? Has to be very smart. How do you mitigate risk? How do you get confidence in the model as you make returns on initial investment and then play with the house's money and essentially take more risk subsequently? These are all techniques that we use and can be fully automated and driven by machine learning. And hopefully we'll have some time to talk about those, but maybe that will be a second, if we're going to be invited to talk about these things as well in another webinar. So they're all great questions.
You're invited.
Thank you. All right, Taylor.
I'll try and wrap this up quick, get out of the technical stuff here. RC curves are actually a precursor to a single number, which is called an AUC. It's a good way of evaluating whether a model splits those distributions well. The column of charts on the left would be a low AUC score, whereas the column of charts on the right is a high AUC. AUC just stands for area under the curve. The curve that you see up top is something called true positive rate versus false positive rate. And these are all Googleable things. I won't get into it now. Confusion matrix, ROC, AUC, put those into Google and you'll get more than I could probably explain to you.
But Taylor, I think it's important to tell them that the idea is to distinguish between these two classes, right? So you have an overlapping. Yeah, so go ahead, sorry.
Yeah. And so a good model splits the classes well and allows you more room to mess with the threshold, right? A perfect model splits them perfectly, meaning there's no overlap, there's no purple region here. In finance, things tend to look more like the left. To be frank, a model that has 56% accuracy is actionable. A model that has 60% accuracy is not going to be shared because it's going to make a lot of money. So you don't need much, you just need an edge. There's no such thing as 90% accuracy in finance, for machine learning at least. So I'll try and bring it full picture here. You've built a model, it predicts something based on some alternative data. From what I've kind of been describing this whole time was what we would call the bottom up. I think there was a question before that kind of talked about like, how does all this come together? How do you mitigate risk? Well, one, it's not just one model usually, it's a lot of models coming together, all producing some sort of sentiment or prediction across a universe of securities. And at this point, it becomes a little bit of a portfolio construction problem. And there's a lot of ways to do this. Someone mentioned reinforcement learning before. A lot of cool possibilities there. There's also just the traditional methods, portfolio construction, optimization, Markowitz, modern portfolio theory, all that stuff. That's all applicable here, right? So you have some sort of predictions that are coming in. You're going to have a covariance matrix usually to control risk, depending on what type of model you have. Maybe it's just Markowitz, or maybe it's a factor model or something like that. Those are going to be the things on the top here, your top downs, your models that are understanding macroeconomic risk or consumer sentiment risk, whatever it may be. These are the things you're trying to typically hedge out. The covariance matrix is going to handle your price fluctuation or your variance. And the top-down models, the factors, are going to handle your risk and making sure that you're not exposed to things you don't want to be exposed to, whether it be regional or sector risk, etc. And when that all comes together, that's how you build a portfolio. And this is an example of a portfolio that we built that takes numerous models and combines them together. This chart you see on the left is a correlation matrix of all the different models that are coming together here. I'm sorry, I can't read any of the text, so I don't know what the color coding is. I believe dark means uncorrelated and the lighter colors are more correlated. And so basically, it's all the columns are the same as all the rows. And so you have this diagonal where obviously a thing is coordinated or correlated to itself. But what you don't want to see is like a vertical column of all white, or a horizontal column of all white. So anyways, this is an example of bringing multiple models together into one strategy, and then that's a back test of that strategy. And this is an actual strategy that runs today.
As let me quickly interject here, as the famous Yogi Berra once said, in theory, practice and theory are the same, but in practice they're different. So this is a back test, and you can see it looks pretty awesome. Obviously, the orange line is our back test. You can see there's a very low drawdown, very nice Sharpe ratio, which measures the volatility of the outperformance against the benchmark. You can also identify, of course, absolutely a return against the benchmark. But again, these are the type of things that we test. It looks decent, then we go live, and even it comes across as 80% of what you see here, it's still very successful strategy. So this is one of our models actually we are running real money with. So anyway, just wanted to mention that.
That might be my last slide.
I mean, really and truly, we have, Taylor, I want to go over the event study technology, and maybe you can help me there. We can go through this quickly, and then we can talk about other questions and answers, and we can maybe wrap it up in about 15 to 30 minutes if you have time. If everybody still is interested, to stick around and ask questions.
Yeah, we have time, no problem.
So I want to show you something called the event study, which is one of the ways for us to identify, how predictive a classifier that Taylor was talking about is. Classifier that says to you, should I be in a stock? Should I buy the stock today? Should I not buy the stock today? Or should I go short? It's 3-state classification. One of the ways to evaluate it is to see, okay, what is the decay of the signal from the data that the model that we actually are deploying, right? And there's ways to identify what we call alpha decay. What is the time frame by which the signal no longer provides information? And there's many ways to do that. But one of the ways to evaluate it is something called an event study. Now, people think about event study as an event in the market. Somebody announced earnings, an event, or somebody resigned from a CEO position, or a board fired the CEO. These are all events that could drive a stock. But for us, events are inflection points of a signal, of a data signal. So if you have, for example, a spike in the newsfeed activity for a given company that's not normal to its cadence historically, that's an event. That's an actionable event. If you have an RSI, which somebody mentioned before, that just jumped over a certain threshold, that's an event. So a single factor can create an event, but what happens if you create a multi-factor event? For example, a P ratio between X and Y value, and a beta between X and Y value, and a gross margin from X and Y. When you combine them together, you have this little overlapping region that if you have positions, stocks that meet the criteria of these three factors, that would identify a signal by which we should act upon. That's what event study is. And there's ways to evaluate historically if this is true or not. So let me show you how it's done. So here's the idea. You have a filter that can identify by a scan. It's a simple scan, just a regular scan. Any type of technology that has stock filtering, a screening, is capable of doing that. And you can identify, so let's say you run a scan every day. Every day at 9:30 a.m., you run a scan, and you go back in history, in time, and you say, okay, I want to go back a year ago, and I want to run a scan on these factors, these three factors I just mentioned before, P ratio, beta, and gross margin. And I want to see what comes out of that scan. And Apple, in that case, came out of that scan. So I can mark the day in which Apple was triggered by this event. It's a three-factor event. So there's a triggering mechanism. Here's Apple just came in. And I can measure the price action of Apple before the event and the price action of Apple after the event. Because what's the idea? I want to identify what's the leading behavior into the event trigger and what happened after the event was triggered in the future. Okay, that's just one case, one stock, one event, and one point in time. But if you do it across multiple times historically, and you identify this before and after behavior of any type of triggering event, right? You can see here it's done, the before and after, and you combine all of these together into an aggregate view, as you can see here, all the befores and all the afters, and you draw a line across the mean of these behaviors, you can see very clearly the average behavior before the event and what happened to the stocks on average after the event. This is what the machine is trying to exploit, essentially, is to identify what are the factors that would give me a scan that would provide me with a consistent behavior that's outperforming the averages or the benchmark or the market S&P 500 in many cases in the future. And that's what the machine is trying to identify. Now think about it. There's a 950 factors, and you have a 3-factor or 4-factor combination. It could be a number with many digits. It's not something you can do. Human cannot do it effectively. Even machines cannot do it with a brute force search effectively. You need the machine learning to do that, and that's really what the classifier is doing. And you can see, I can look historically at a cone that shows all the behavior of all the outperforming and the underperforming of the events historically. And I can ask the machine to fine tune the factors that would give me stock that would behave more like the ones above the mean line versus the one below the mean line. And we have technology to do exactly that. So you can see I can highlight this region in the event study, and I can show you exactly how the behavior is manifested, to support that region in the graph that the machine is trying to target. So how to create these factors that would scan for securities that would behave more like the ones here and less like the ones here. Hopefully that kind of made it clear as how we use event study to create these type of measures. This is, by the way, coming straight from our platform. We can do it in a very highly visual way. You can see there's a 3-factor model. This is a Benzinga news sentiment that we use here. We use an EBITDA rank and max drawdown. You can see 3 different factors. These are the min maxes that Taylor was mentioning about normalizing the values, and it's a min and max values for the scan to create that kind of selection of stocks that are going to be used for that event. So imagine I can run this scan, this filter every day, and every day I get 5, 10, 15, 20 stocks, and I say, okay, whatever cash I have available in my portfolio, equally allocate between those 15, 20 stocks, and repeat that until those signals don't represent these stocks anymore, and then take some of them out, put the new ones in that are now coming on in contention of the filter. And this is a dynamic portfolio that can kind of continue to evolve over time. And you can see this is exactly what we do. The green indicates winning events. The red indicates losing events. You can see you want to have more winners than losers. You can see how the mean line behaves, which is where you want to have a very nice bias to the upside. And of course, it's all coming directly from our platform. Anyway, I want to stop here and see any questions, and we'll try and kind of answer as much as we can in the time that we have left in this presentation. Let's see, we have a few great questions here. Let me see. There's questions here about overfitting, about the accuracy of 75%. I would agree with that. If you have that kind of accuracy, again, in a real world, you're going to buy islands. You don't have to worry about anything else. Okay, backtesting. Yeah, so we have a very comprehensive backtest simulation, and there's a lot of things that you have to be aware of in a backtest, because there's a lot of backtests are prone to false positives or false sense of security on the strategy. For example, considering transaction costs, considering slippage, which is basically there's no guarantee that the prices you see on the ticker is what you're going to get when you buy a big block of shares, especially when you have a thinly traded stock. So impact models and transaction cost model have to be considered. Of course, again, data has to be survivorship bias. So dead stocks historically should be still considered when you do a backtest historically. Otherwise, you're going to get a very favorable result that's not representative of what really happened in the past. When you buy stock, you buy it at the open or the close. You buy it, what's the timing of the entry, and all these things are done really on our platform. I want to show you quickly just to give you an idea of what it looks like, what a backtest looks like. This is our platform, by the way. You can see kind of what it looks like, but I want to go and bring up a backtest from our queue here just to show you what it looks like. It's a lot of information that we capture on the backtest that we build ourselves just for the sake of our research and how it kind of works. So here's an example of a portfolio that's optimizing, I believe, on a predetermined period. So you can see, there's the results, but obviously there's a much more robust view of that result. I'll try and bring it up on the screen here, including the transaction history, so you can see what it looks like. So you can see we check to see the relative return, the beta, the annualized volatility, the Sharpe ratio, the max drawdown, information ratio, tracking error. I mean, it goes on and on. There's a lot of stuff here. Of course, the annualized return, annualized volatility, the scatter chart with risk return, and it goes on and on and on. This is an exposure graph. This is rolling stats as far as factor attributions, capacity limitation, and it goes on and on to all the things we care about. Average number of days. Somebody asked me for what's the average hold time. This particular strategy has a 20-day on average, or 15.89 to be exact, with cash weighted. And of course, as you scroll down further, you have the turnover analysis. How much are you turning over in the strategy? And of course, the actual transactions and the allocations per each rebalance period. So we do a pretty, we go to a pretty great length. This is, by the way, a very simple backtest to evaluate, how you can see, by the way, here, the slippage and commission are all factored into the backtest. So we measure it very carefully to ensure that it's representative of the real life scenario. Hopefully that gives you some idea of what a true backtest should look like. More questions. Okay, about retail investors. So truly speaking, we are not targeting as a business retail investors. We love to educate. We love to talk about what we do, because I think it's cool stuff, right? It's the next generation of investment. And I think the people who realize that this is the way to go, the faster you realize, the more equipped you are going to be as to what's going to happen in the market. We don't make the technology or any of these things available to outside investors. Even our institutional customers don't have access to these tools. It's used internally by ourselves, by our quants and our data scientists. But what we can tell you about, and if you are interested in learning more about what we do have quite a bit of model portfolios that we can track. We can give you access to be able to see them as they evolve over time, and hopefully can give you some sense of what model portfolios look like and how they operate. So we can definitely provide you some links to our website and access to these type of portfolios in real time. Any other questions, people? I'm happy to answer, and Taylor can obviously provide more color on the technology itself.
I guess one question, Erez, could you talk a little bit about I know in other presentation I've seen the day trading system, I think it was S&P, or no, it was some other stock index.
The Nasdaq futures, probably.
Yeah. Mm-hmm.
Yeah, I mean, there's so if you guys, and I saw some questions about deep learning but we definitely use deep learning. Don't get me wrong. I mean, again, like Taylor said, it's for the right problem. We would love to use the right solution. There is a technology we developed over time, which I didn't really cover here in this presentation, which is how to apply, image classification or pattern detection using image classification for trading, right? So essentially, think about, all the technical traders look at the Elliott wave and look at all kind of inflection points of time series of price movement. We can actually do a fairly decent job using deep learning computer vision technology, by which the pattern of the stock can be used as an image to classify historically what pattern has yielded the highest successful outcome. But again, it's not just one pattern or one time series. We overlay multiple time series together, right? So let's say you look at the price and volume. So price fluctuation over time and volume over time can be used together to identify inflection points, again, through deep learning, image detection, or pattern detection, to identify how maybe a spike in volume and a movement of a price to the downside indicates a mean reversion, or may indicates maybe a short momentum opportunity. So these are the things that potentially in the future we'll be happy to come back and talk to you about as well.
Okay, Prakash, you wanted to ask something. Go ahead. He wants to use the mic. Please do.
Sure.
That's a great idea.
Yes, Erez, Taylor, it's a great presentation. I mean, we learn a lot. One is more than a question. Actually, is an observation or comment, and I would like to know your comment on that.
Sure.
So, so all this backtesting, statistical analysis, AI modeling, everything is basically on the historical data, right? So it's a statistical analysis of historical data, using which we are trying to predict the future, right? Mm-hmm. So in my observation, I mean, I'm doing this quantitative analysis and is a one-man shop, but I'm doing it for a while, several years now. So my observation is way over 90%, there is an order in the market. Okay, and this order thing is more or less in a bigger picture of life too. Way over 90% stuff is order. A very less chaos happens there in the world. Same in the market. Okay, but the amount of chaos, even if it happens 1 or 2%, and now we can call it chaos as a Fed chairman's comment or some drug approval or this and that. Okay, even 1 or 2% of the chaos that happens, that has a capacity to start a complete new order, okay, or dismantle the existing order, okay. So there goes over all the quantitative modeling and everything, okay. So what I'm trying to wrap my mind around is the way I built my quantitative system is more than 99% of the thing is driven by the AI. It's driven by the logic. But there is some scope, okay, 1 or 2% scope for manual intervention, okay, and I just couldn't figure it out that to eliminate that, and I have tried it running it in a different time span to eliminating the manual intervention completely and letting it do the machine, and it does very poorly. Okay, so I just like to know your comment on that. I keep on hearing that
Sure.
the quant saying that they are 100% fully automated. I haven't seen one with my own eyes.
Well, I can tell you, we have plenty of those that are fully automated. Again, it's not the machine did not conduct or construct the strategy, but once it's constructed, it's completely automated, and not a single strategy that goes out to the market from our perspective is doesn't have allocation guidance, stop loss and target gain guidance. And of course, the whole features selection and the stock selection guidance is part of the strategy construction. If you think about what, and by the way, I'm not surprised that it takes a lot to make algo strategies work. You know, most companies that I know that have tried to do that have not been successful. There's a few that have done really, really well. Some of the big names, obviously, that you hear about the hedge funds have done extremely well. But for the most part, many have not been successful. And there's two reasons. Number one, many don't trust the machine. So naturally, if you are a trader, you get a gut feeling and you basically throw everything out and you just interfere yourself, because that's the human's nature. You know, okay, the machine is really good, but let me just put some thoughts because I see a mean reversal and I see volume spikes on the ticker, and I want to buy the stock now, and then everything goes away. So that's number one. You're not true to your algo approach, and number two is that you don't have the proper tools to identify all the potential conditions for exit and entry. Again, we have a strategy that's been running for just about a few months now. That's the intra-day future strategy that I was presenting in another session that Don actually mentioned before. This is completely algorithmic, and it's get about 20 to 30, maybe 40 trades per day. It's phenomenal. It's been doing really, really well for us, and it's completely hands-free. I mean, we don't. Every time we get involved, we screw it up. So we try to keep it for the machines to do what they need to do on a perpetual basis.
I had two thoughts on what you were saying as well. The first is really just maybe a thought exercise for you. I tend to think of what you were explaining in the beginning as explainability. If you're looking after the fact at market returns and you're trying to determine the explainability of it, you're probably right. I would say, depending on how much data you have, things become more explainable, obviously. But also, depending on what time horizon you're looking at, some things are explainable and some things are not. I think things are the most explainable at the tail ends of that time horizon. So on a long time horizon, things become very explainable. You know, the market goes up. Good companies hopefully do well. And on a very, very short time scale, things are also very explainable because it just becomes, primitive buy and sell pressure. And so everything in between is a little bit of noise, depending on how far you get away from those two extremes. You mentioned having a model that is 100% hands-off. One of the slides that we presented today mentions how our models are constantly retraining. Yeah, I think you're correct. Building a model that is set it and forget it, truly, like it learns one time and it performs forever, that doesn't happen. Every one of our models that we've built to date, or at least in the last 5 years, retrains on some schedule or on some heuristic. So what I would recommend trying, a little bit of advice, is when you're building these models, pay attention to your inputs and pay attention to where your inputs stop looking like they're on the same distribution and consider retraining. Or you could just look at when your models start underperforming. But I think it's almost more preemptive to look at when the values that you're seeing, your independent variables, suddenly don't look like anything you've ever seen before in your historical training set. Then you probably you don't have a model that can predict that at that point, and you should probably retrain, or if you don't have the capacity to retrain on that spot, to turn it off, right? So anyways, that's what I wanted. That's what I wanted to add to that. Every one of our models retrains. Every one.
Thank you. Great answer. Thank you.
Yeah. You're muted, Erez.
Yeah, so Don, I think we covered most of the questions that were asked here. If there's anything else that people want to reach out to us, by all means, link in with me or send us an email, or if you want to consolidate questions, Don, and shoot our way, we'd be happy to answer those. And we're serious. We would love to come back again and talk about specifics. Maybe do a session about our intraday future strategy and show you kind of how it works and how the logic kind of executes without giving away the secret sauce, obviously. But I think it'll be very informative for some of the folks.
Yeah, absolutely. We love it. We love it.
Yeah, but I appreciate the opportunity to present today. And thanks for all of you who came to listen to us today.
Okay, you want to give an email address or?
Sure. You can reach out to me directly, Erez, E-R-E-Z, at Neuravest.net. Neuravest is Neura, the neural network, N-E-U-R-A, and Vest, like investment, Neuravest.net.
Erez at Neuravest.net. If anyone needs it, let us know. Fantastic. Anything else that you want us to do or that people should be aware of?
Yeah, well, I don't have a good clear understanding of the crowd, who's actually on the group that's listening to us today, and what's their experience level, what do they do as far as investment. So maybe for the next round, it'll be good to understand a little bit more about the audience, because we can change the depth of details of the technology, up and down, depending on who's listening. So just for the future, we'll be happy to kind of come back and get deeper if we need to, or stay higher level if we need to as well.
Absolutely. We'll survey people and try and get you that for another time, for the next time.
Sure.
Unless anyone has any further questions now, don't hang up everybody else, because I want to continue on a couple of points separately, unrelated to, or following on to this presentation. But for now, thank you very much to both Erez and Taylor. We hugely appreciate your time at this time of the evening.
Wonderful. I'm going to send my email address to everyone on the chat here, so you
please
can have
do.
it. And thanks again. It was a lot of fun. Have a good evening, and have a good day, and happy trading. Talk to you soon.